Crack on straight to our next speaker, who's going to be talking to you about the financial crisis, gold and climate change. From XTB, I'd like to welcome up Farah Mourad. She is the Senior Market Analyst at the company. Farah, if you'd like to come up, please. Sorry, Farah Mourad. I can't even read my own writing.
All right. Hello, everyone. It's a pleasure to be here today. It's Farah Mourad, Senior Market Analyst for XTB MENA. We're very happy to be here with you, and hopefully we can shed a little bit of light of what would happen in the markets in the upcoming future and help you take smart, hopefully, investment. So as it shows, we're going to talk about economic instability, gold, and climate change. I just want to have a question really quickly asking you. Do you believe that we're heading towards a financial crisis soon, yes or no? You can raise your hand if you feel like this is a potential scenario that's going to happen in the financial market. So just one person. Okay, that's a bad sign, actually. 2%, okay. So, you know, whenever there's a bubble happening and a crisis just around the corner, it's usually when the markets are looking the other way. And whenever we fear a certain crisis, it's actually a good thing in the markets because, you know, we're fearful and crises don't happen when we're fearful. And I'll just move to one of the main or most beautiful quote that I've heard in the financial market, which made me actually fall in love with the market. It's, if you watch close, history does nothing but repeat itself. What we call chaos is just patterns we didn't recognize. What we can't read, we call nonsense. There is no free world, there's only patterns. So the thing is, everyone here is just trying to decode patterns to know how to trade better. And this is what we will try to discuss today. If you can see this picture, for example, here, what do you think have in common? These are all crises that happened throughout history. And they started, the first recorded one was in 1772. And then we have the Asian crisis, we have, you know, the Great Depression, we have the stock crash in 2008. And they all have one thing in common. Any idea what that would be? It's human greed, actually. They all have that in common. And this is mainly the biggest risk on the markets, human greed, short-term greed. And this is why we believe that a potential bubble is actually in the making. There's a lot of characteristics to this bubble. And what we are witnessing today, there's many of these characteristics that are present. First and foremost, it's put-call ratio. We're having it at the lowest. It's something related to option. But if you want to probably see the alternative of that in the financial markets, let's say RSI index. It's at the highest level. It's a huge bullish market. The other sign for a bubble that's in the making is actually brokers, let's say option brokers. They need to hedge their retail client position. So they actually buy more stocks, and they're making this trend go even higher. The other thing to take into consideration that all of this, you know, bullish market is also created by the federal bank, the liquidity that is injected in the market. It's not really based on the fact, you know, the healthy economy, we have huge demand, the prices are going up, the stocks are going up. No, it's mainly based on the fact that the federal bank is just injecting more cash in the markets. And the last and probably one of the main characteristics of a bubble in the making is actually that there's a lot of IPOs, new listed stocks in the market. We're hearing a lot about hot stocks, and that's also not really good for the markets. And I've seen now a lot of people just don't think that we are in the middle of the crisis. Probably we're all waiting for a new times high, probably on the stock market, and this is a bad sign. This is probably, we are moving into, you know, a speculation bubble. A bullish market created on the fact that a lot of people want to make more money from the bullish market that we're seeing. So what happens now? We already saw a huge spike in inflation rates. And this inflation is not really created by the fact that there's a huge spike in demand. It's just because there are a lot of liquidity in the market that's making the prices go even higher. Another sequel or aftermath of this high, crazy bullish market is the US recovery track. I will show you that even though we have the most aggressive plan to try to fight, the post-COVID recession, we are still way below pre-COVID levels. And the negative data pushing bulls to buy more. I will be discussing this further. For example, here we have graphs showing US recovery track. And we can see in most industries, even though we see the federal bank and most of the central banks trying to inject more cash in the market, we are still not back to the level pre-COVID. Whether it's in finance, mobility, production, employment, demand, health, we are still below pre-COVID levels. At the same time, the consumer card spending or the consumer behavior, we are still not spending a lot. We are still fearful. So even though the inflation rate is getting spiked up, there's nothing to back this when it comes to human consumption or consumer spending. The other thing that we are witnessing as well, the more bad data that we have when it comes to economic indicators, the more bullish the market is getting. For example, let's say when we had the non-farm payrolls in August, we had really bad non-farm payrolls data. But we've seen NASDAQ, for example, reaching all-time high. That is based on the fact that the federal bank is kind of, or have to, keep on helping the market as long as we have negative data. And this is taken as a more bullish sign for the markets. So the more bad we are, we're more in a bad condition we are, probably the federal bank needs to help us more. So that's a buy sign, which doesn't really make sense. So what now? Do you feel like maybe you are heading to a bubble or not yet? Okay, so we've been all discussing or talking about, kind of recovery that we will see, post-COVID, whether it's a V-shape, U-shape, L-shape. We heard all kind of alphabet shapes. It seems like we're seeing actual recovery in certain industries, while other industries are actually still suffering. So most probably, I would say, we are in a K-shape, where some industry are recovering, others not quite much. And here's a fun photo of, Jerome Powell, who has probably the most powerful weapon in his hands, just print more cash, facing Superman. So we are in a situation, as I said, bad is good. The bad data we have is actually a buy sign, which is really not the way that economy should work. Economy should work as simple as we know. A rise in demand should have a rise in prices, and that's as simple as it gets. So now we know that the moment we hear the federal bank is saying he's going to cut on cash or he's going to just reduce the liquidity in the markets are taking it as a sell sign, even though all of this plan was supposedly not to have a bullish market, simply just to survive the markets during COVID. And we see shift on the FX market. The moment that we've heard that probably the federal bank is going to cut on liquidity, we've seen a spike on dollar. Is that correct? So basically, that would be also a bad sign for stocks, where we might see, deeper correction at the moment. There's a very nice, I think, sentence said by JP Morgan regarding gold. Gold is money, he said. Everything else is credit. Who believes in that? Just one person as well. Okay, so why do we think that gold is the safe haven during crisis? There's a lot of reasons behind that. First and foremost, it's an anti-inflation asset. Whenever there's a spike in inflation, it means that the dollar you have or any cash that you have is not going to have a lot of value. If you want to save your capital, you need to switch it to another asset that would allow you to reserve this value of the capital that you have. And this is why over thousands of years, it showed that it's an asset that can survive the test of times. And this is why it's It's still considered as a safe haven. The other thing that makes gold shine during crisis is that its price is actually not based on speculation. The value is in the gold itself. And this is why it can still be considered as an asset during crisis. And, okay. And if we can see that the monetary policy, I don't know if you're aware of that, but the federal bank is trying to cut on their purchases for bonds, and at the same time, probably during next year, he cannot, until next year, reduce the interest or increase the interest rate, which means that the stress on the dollar is going to remain for a while. And the more stress we have on the dollar, the better the gold would perform. We're all aware of that or not? If you need me to explain a little bit more, because you know the gold or any other commodities, they are priced by dollar. So the moment, even if there's nothing new in the market, the moment dollar goes down, we can see a very positive effect on the gold market, because it is valued in dollar. Okay, so even when we're checking the technical analysis or the geometry of the markets, we have seen a deep correction since it hit its all-time high. And we think that this correction might stay for a while. So whoever is bullish on gold, we think it could be a good opportunity for you to start, considering it as a hedging against inflation. And we can always look on what the Fed is saying. The federal bank is gonna do any new policy that would strengthen the dollar. We will see directly the effect on gold. It would go down whenever the dollar is strong. It will go up whenever the dollar is weak. And there's one thing that's here in XTB we offer our clients. I think it's very important to look at. It's our platform, XStation 5. Have a look at it, because let's say you're trading on gold and you want to see the effect of news directly on the market, instead of having just the economic agenda in front of you, the chart in front of you, and just seeing how news are affecting the market. You can have it right on the chart. Any news that you want, you can see if it's high importance, low importance, and you can see how it's exactly changing the chart and affecting, even the candle at the moment that the news are, out. Have a look at it, because even XStation can have instant market updates, instant market analysis, the economic calendar, as I said. It's quite interesting if you care about the fundamentals that might affect the market. Okay, so now we have new risks, new territory. I think this photo is quite disturbing. Do you know whose eyes are these? Okay. Yes, correct. Okay, so what are these new risks? We are aware that we're moving into a territory where already the markets are over-flooded with artificial help. We already know that even if we manage to pass this period without having a crash or a huge recession, we are still not really in the best, I would say, rhythm of the markets. So what if just right around the corner, we have a new risk that would depress productivity and would divert, the capitals of big companies from actual production to less productive aspects. A risk that would increase public debt. It already cost us in 2019 146 billion loss. Already cost the insurance bill 60 billion. And costing 1 trillion from global GDP. So how do you think we can overcome all of these, even though we are already moving from an actual crisis? All of these are actually happening. And do you know what crisis or what risk that is? Climate change. It is actually affecting the market. It's not just a thing that we hear on the TV, it's actually affecting the market. And what we're trying to discuss today is the potential of you rethinking your investment plan based on that. So what's the forecast for climate change and its effect on the economy? Banking crisis, would rise by as much as 248%. Having financial crisis would rise it would happen by double time. Like let's say every 20 years we have a crisis, we might have it every 10 years. It would impact 48 countries, which represent 90% of the global GDP. It would be responsible of 50 to 80% of economic losses. World economy is set to lose 18% of its GDP because of global change. China is probably one of the top. Even all Asian countries, all Asian economies would probably be hit the most. China would probably has around 24% of its GDP wasted on climate change. And then we have US, close to 10%, Europe, almost 11%. So imagine we're spending that much on things that doesn't really affect productivity or expansion. It's just that we need to change the way that we're doing things so we don't affect the climate. Are we moving towards an economies where everyone is on its own, deglobalizing the globe? Because, you know, the US, the Europe, they don't need to be part of a bigger plan, for example, to help Asian countries to solve the problem. While this is still an issue to debate, but we should take it into consideration that maybe every country would be on its own. Would see, like, no, this is my own issue. I will deal with it. It would cost me less than actually working with another country to solve the problem. So here's a map that would show potential lawsuits against companies that are affecting climate change. And imagine if it goes really big. Imagine if there's a lot of huge companies that are, you know, going to court because of this. It would definitely have its effect on stock market, for example. We can see more stress happening in the stock market. Price of net zero emission. Until now, we can't really figure out how much it's going to cost us to have a net zero emission. There's rumors that it would probably cost around 38 trillion per year, and we're still not sure about that. Increased losses to economies that, you know, we're already using, you know, the liquidity that we have in the markets, quantitative easing, to pass through the risks that COVID added to the markets. So imagine if we're going to be hit by another risk. How can we survive that? Another quantitative easing? Climate change should be at the center of our investment plan. How can we do that? Are you interested anyway about did you change your mind about, you know, the future territory of the financial markets? You're saying no. Can I know why? Can you please come in? I would like to know why you think this would not affect the markets. Okay. So how about, let's say, in commodities right now, energy. We're seeing a spike in natural gas. We're seeing spike in oil. All because, let's say, there's a hurricane happening in Texas that it's affecting production. Even the natural gas in Europe crisis is based on actual issues of climate change. And we're seeing spike in these prices right now. Honestly, I cannot hear you well, but I would love to have discussion with you at my booth. It's XTB MENA. I'm waiting for you to discuss this even further. Okay, but I do believe that, you know, being forced to create an infrastructure that is, you know, environment friendly, that would change the way that we would invest in the future. Having all these effects, let's say all the floods that are happening that would affect insurances, it would create a whole different, you know, environment for how insurances work in the future. So I think it would definitely be a huge effect on the markets. And it would create possible opportunities to move beyond the COVID crisis. For example, if we want to think of ways or opportunities to move beyond the COVID crisis, if we start right now on the short term, we can create opportunities innovative plans, create more jobs by moving from, a high emission carbon industry into a more friendly one. Imagine the number of, the jobs that will be added simply by switching the way that all of these industries are working. As on the midterm, creating new sources of growth and sustainable territory for investment. On the long term, though, I think it's the only way for us to survive on the planet, whether it's for the financial markets, whether it's our private life, and everything in between. That's pretty much it. If you have any questions, we would be very happy to have you in our booth and discuss further all the opportunities that you would think of. Thank you so much.